A very good evening to all the participants of this webinar. We are starting part 2 of Consignment Accounts as part of the Bookkeeping and Accounts series for DTRTI Lucknow Webinars 2021. And I'm Arvind Mishra, Deputy Director, welcoming you to this webinar. Now, today we'll start with the situation in consignment accounts where goods are invoiced above the cost. Now, sometimes the pro forma invoice is made out at a value higher than the cost. The pro forma invoice is that document which is sent by the consignor to the consignee, and it contains the details of the consignment which is being sent to the consignee. And there is a value mentioned in there in the pro forma invoice, and sometimes the pro forma invoice is made out at a value which is higher than the cost, and the items which are sent are valued at higher than the cost in the pro forma invoice, and entries are made in the books of accounts on that basis. Even the inventories which are remaining unsold will initially be valued on the basis of the invoice price itself, the pro forma invoice price itself. Of course, later on their value will be different because at the end of the year, the cost or the realizable value at the end of the year will be taken. Now, it must be remembered, however, that profit or loss can be ascertained only if the sale proceeds plus inventories on hand are valued on the cost basis. If the sale proceeds plus the inventories as valued on cost basis is compared with the cost of the goods which are sold along with the expenses incurred on those goods, then only we can ascertain the cost. So, as profit or loss cannot be ascertained without using the cost basis, hence if entries were made on the invoice basis, then there will be effect of the loading or addition. Loading is the amount added to arrive at the invoice price. So this effect of the loading must be removed by some additional entries in order to find out the profit or loss, even if we have valued the items in the pro forma invoice at a value which is higher than the cost. Well, this also helps the consignor to keep the cost hidden from the consignee, and it also helps the consignor to try and sell his products at a higher price. Now, supposing in this example which was given above, which we have done in the earlier webinar, if the invoice was cost plus 20%, that is 60,000 instead of 50,000 for the goods sent to Y. Then let us see in the previous example itself how the entries would be. So, in order to get a hang of the question, let me again go back to the question and read the question out once again so that we are familiar with the question that we are solving here. X had sent on 1st July to Y goods costing 50,000 rupees. Now here it is being said that instead of 50,000 rupees, X has valued them in the pro forma invoice at 60,000 rupees. And X has spent 1,000 rupees on packing. Thereafter, after 2 days on 3rd July, Y received those goods which were sent by X, and he sent his acceptance to X, sent his acceptance to X means there was a bill which was sent, so he accepted the bill and sent it back for 30,000 rupees payable at 3 months. Now Y spent 2,000 rupees on freight and cartage, Y also spent 500 rupees on godown rent, and Y also spent 300 rupees on insurance. Now comes 31st of December 2016, and Y sent his account sales, the account of the sales made by him, along with the amount which was due to be paid to X, that also he sent along with it. And he showed that 4/5 of the goods had been sold and 1/5 were not sold. So 4/5 were sold and they were sold for 55,000 rupees. Now Y was entitled to a commission of 10% as per the agreement between X and Y. Thereafter, it is also mentioned that one of the customers of Y has turned insolvent and he could not pay rupees 600, which was due to be paid by him or which was due from him, and we had to show the journal entries of such a case. And we have already discussed earlier that the first thing that we are going to do here is that we will be debiting the consignment account with the 50,000 worth of the cost of the materials which were sent. We are debiting the consignment account and crediting the goods sent on consignment account. Now, when we are crediting the goods sent on consignment account, here it is acting like it is basically this goods sent on consignment account will consist of those goods which were earlier purchased. And now these goods which were earlier purchased by X are being sent on consignment basis to Y. So therefore, when they are sent to Y on consignment basis, first what we will do is we will put them out of the purchase and therefore we will put them in the goods sent on consignment account. So basically we have to take them out of the trading account for some time and put them into the consignment cycle. And once we complete the consignment cycle and the goods are sold and we ascertain the profits, the unsold goods which are left out, we will again put it in the consignment account, and we'll close the goods sent on consignment account by transferring it to the trading account. So as you can see here, goods sent on consignment account is being credited with 50,000 rupees, and consignment account is being debited. Consignment account will be used to find out the profit and loss on consignment. So when the goods are to be sold, the goods which are being sold are being debited to the consignment account. When they are sold, they will be credited to the consignment account. All the expenditures thereafter will also be debited to the consignment account. As you can see here, the expenditure on packing of 1,000 rupees is being debited to the consignment account, and then the bill which was received as an advance payment, that is being debited by the consignor in the bill receivable account, and is crediting Y with it. Thereafter, on maturity, this bill gets paid, so we debit our bank account or the consignor's bank account and we credit bill receivable. Now on the other hand, the sale is made, and in respect of the sale, Y is debited and consignment account is credited, as you can see here. Thereafter, some expenses have been incurred by Y, which are packing, cartage, other things. They are also being debited here and credited to Y. Thereafter, because these are the expenses which are incurred by the consignee, or they are the bad debts suffered by the consignee, like this 600 rupees, the bad debt. So we debit the consignment account in respect of these expenditures because these are the expenditures of the consignment, and we credit Y because these have been incurred by Y. Thereafter, commission is being paid here by debiting the consignment account and crediting Y with it, and then we are sending the remittance of the money which is due to be paid of 16,100, and therefore debiting the bank account with that amount. The calculation of this amount is then of course we'll just come to that, but here we can see the amount which is remain unsold. The inventory which is remaining unsold is the 1/5 of the total inventory that was there. So 1/5 of the cost was 10,000 rupees, and then 1/5 of the expenditure on packing 200 rupees, 1/5 of the freight of 2,000 rupees, 400 rupees. So total 1/5 of the expenditure which is incurred by consignor is added to the cost, and we get a total cost of the unsold item as 10,600, which is debited to inventories on consignment account and credited to the consignment account, because this will come on the credit side of the consignment account and will help us to find out the profit. Thereafter, in the consignment account, we are left with a balance of 5,700 as a profit, and that is being transferred to the profit and loss account here. Then finally, what we do is that we had started the credit in the goods on sent on consignment account by crediting that account. Now we are debiting it. We are debiting it and straight away crediting the trading account with these goods sent on which were sent on the consignment. So goods sent on consignment account debit, and by the debiting the goods sent on consignment account, the goods sent on consignment account is therefore squared up, because the initial entry was the credit in the goods sent on consignment account, as you can see here. Here it was a credit. The same amount is being debited here to close this account now, and the credit is going into the trading account of this amount of 50,000 rupees. So thereafter, now what we are studying is that we are supposing these goods were invoiced at 10% higher, or let's say 20% higher, then the higher amount at which they would be sent in the pro forma invoice would be 60,000 rupees, because 50,000 rupees plus 20% is 60,000. So the entries would be like this: that goods sent on consignment account will be credited with 60,000 to start with, and consignment account will be debited with this 60,000 rupees. Because goods have been over invoiced or invoiced above the cost, then thereafter 1,000 rupees is being spent on packing, which is shown here, consignment account debit to bank. Then bill receivable debit to Y, that is a bill which is received from Y on his acceptance. Then that gets paid. So bank account debit to bills receivable. These are the same entries that are there in the earlier example also. And thereafter 55,000 rupees worth of sale has been done, so that is going to the credit of the consignment account and debiting Y. And thereafter, consignment to Y account is debited 3,400, and to Y, which is consignment account, is debited here for 3,400 and Y is credited for 3,400 here. And thereafter, this is the expenditure of the total expenditure being incurred by Y, 3,400, and Y is being credited for that because Y will be paid this amount. And consignment account is being debited because expenditure is being accrued there and being part of the expenses towards the business. So will help us to find out the profit and loss or loss in the consignment account. And thereafter, consignment account is debited and to Y here for 5,500. Now here we are seeing that except for difference in the amounts in the entry of 1 and 9. Now here in 9 there is a difference in the entry and other entries are same because consignment account is again debited for 5,500 to Y. Let us see this entry in the above example also. Here it is. This is the commission being paid of 5,500 rupees. And thereafter, the 16,100 rupees is also the same entry, absolutely the same, and no difference. And this is the amount which is payable, in fact, to payable by Y. He has paid this amount. Y has paid this amount to us. And then the inventory is being valued at 12,600 rupees. So here, where the inventory is being valued, there is a difference of the amount. So now what is to be done here is that why this difference is coming, because there are some additional entries happening here, because 10,000 additional rupees is being added to the pro forma invoice as loading. So what we are doing is that consignment account is being credited for with 10,000 rupees and goods sent on consignment is debited with 10,000 rupees because starting entry was credited to the goods sent on consignment account. But here, goods sent on consignment account is being debited for 10,000 rupees and consignment account is credited for 10,000 rupees. So here what is happening is entry 1 is reversed to the extent of the loading in order to debit the consignment account on cost basis. Why we are making these entries? Because we have increased the amount to 60,000 here. We need to bring it back to 50,000. So we have to make a reverse entry of 10,000 rupees here. And thereafter, we debit the consignment account and credit the inventory reserve account. This is the amount of the loading which is included in the value of the closing inventory. The amount of loading which is included in the value of the closing inventories, which is the unrealized profit, and hence there is a reserve which is created here by debiting the consignment account and creating this reserve account. Now let us understand the reason for creating this reserve once again. What is happening is that in the pro forma invoice, cost plus 20% value, 20% value is added so that the better price can be fetched. Now once the transaction is over, we need to value the remaining cost, remaining material that is available, that is left out, and therefore to value that we have to bring the value back to the cost. And so we need to bring the value back to the cost, and therefore the loading that was done earlier, that is to be reduced, and that is why we are debiting the consignment account for reducing the loading and creating the inventory reserve account. So by debiting the consignment account, we are putting this 2000 rupees in the inventory reserve account, because ultimately it will be used to devalue the inventory to the cost level. This reserve will be utilized for that purpose. Now, the consignment account reveals a profit of 5,000 rupees, which is the same as before, no difference, and the profit will be transferred to the profit and loss account. Now, similar entry given in the earlier illustration, we made to transfer the balance in the goods sent on consignment account in the earlier illustration at 5 lakh rupees after entry in A above to the credit of the trading account. So we'll be transferring this is not 5 lakh, but it should be 50,000. We will transfer the credit of back to the trading account, and accounts except for Y, whose account will be same as already shown, are given below. Let us see the accounts which are given below. So first thing that we are doing is we can look at the consignment account here, and first entry that we find here is that consignment account is debited for 60,000, goods worth 50,000 plus cost of 10,000 rupees, 20% is loaded on out here, and this is sold for 55,000 rupees, and finally the inventories are being valued at 12,600 rupees. The inventory is valued at 12,600 rupees because of the fact that there was a loading factor involved here. So to reduce the loading factor, we will put a debit here in the consignment account. So we are putting a debit here to reduce this loading factor of 2000, and so therefore 2000 will cancel against this 2000. But when we are debiting the consignment account to cancel out the loading factor, we are crediting the inventory reserve account with that amount. So in other words, we are creating the reserve, and with the help of the reserve, by creation of the reserve, we are debiting the consignment account to be able to calculate the real profit on the consignment. Now here, goods sent on consignment account, that loading is added here 10,000 rupees, and against this loading of 10,000 rupees, 2,000 rupees is sent to the inventory account. So why this loading is credited here? Because to cancel out this additional loading being made here. Ultimately, we have to reduce all loadings. So here 10,000 was added. So here again, this 10,000 is being reduced. The inventory valuation was at a higher figure due to the loading factor, and this loading factor was 2,000 rupees. So this gets cancelled against this entry of the of debit in the consignment account, with credit going to the inventory reserve account. And after considering all these entries, we find that the balance ultimately of the profit is the same as earlier. In the same example. Now here, goods sent on consignment account, as you can see, when the goods sent on consignment account was credited, the consignment account was debited for 60,000 rupees, and afterwards this 10,000 rupees was reduced as part of the loading, and the remaining 50,000 rupees was transferred to the trading account, because here the goods sent on consignment account is debited, and trading account in turn is credited with this balance figure of 50,000 rupees. So by creating this trading account with this 50,000 rupees, what is happening in the trading account is that in the trading account, these goods were already part of the purchases, Now we have put them into the credit side also. So we are cancelling out the both sides of the trading account, because the profit from the consignment part is separately taken out, and all those goods which are sold on consignment, the profit from that is already transferred to the profit and loss account, but these goods are which are remaining are to that extent the goods which were actually sold, or which were actually initially with which initially the goods sent on consignment account was credited initially. Now the goods sent on consignment account is being debited, thereby squaring off the consignment account, and the credit is going to the trading account. Why this is a balanced figure? This must be understood because these items were initially purchased, and therefore when we have purchased these items, they were put in the purchase account, debit side of the purchase account, and therefore since these items are now already sold out, so we need to do a cancellation entry of that purchase in the trading account, and therefore this credit is going to cancel the purchase amount at the cost level in the trading account. The rest of the entries are same, so we are not going to focus on those entries, but all we have to say is that the last two accounts will be carried forward to the next year, which means the inventory reserve account now has a balance of 2,000 rupees, and we have created this reserve to cancel out the loading. So in a way we carry this forward to the next year, and their balance will then be transferred to the consignment account. So the 12,000 inventories on consignment account. So inventories on consignment account will become part of the final inventories of 12,600, and 2,000 will be on the liability side. So when we look at the balance sheet, these inventories which are remaining are going to on the asset side, getting added to the asset side of the balance sheet, and this 2,000 rupees getting added to the liability side of the balance sheet, and therefore this 2,000 will get cancelled against this again this amount of 12,600 to the extent of 2,000, and therefore only 10,600 amount will remain as in the previous example as part of the inventory. So the balance 10,600 will add to the left out inventory at the end of the year. As you can see here, 12,600 minus 2,000 gives us a value of 10,600 rupees. Now let us look at a situation if the commission to Y includes the del creditor commission also. Now in case Y would not be able to charge the bad debt of 600 to X, because he's paying commission. He's getting commission. Y is getting commission, del creditor commission. So this bad debt will not become part, X will not be paying for the bad debt. So he will save on this bad debt amount. So because Y will have to bear this loss himself of 600 rupees. Del creditor commission is paid to ensure that there is no bad debt. The student can see here that so the profit on consignment will therefore be increased by 600 rupees. So 5,700 plus 600 gives us a profit on consignment of 6,300 rupees. Now when del creditor commission is paid, we are debiting the consignee account in the books of consignor for both the cash sale and the credit sales. So del creditor commission is going to be paid against cash sale as well as against credit sale, but If no del creditor commission is paid, then consignee account cannot be debited for credit sales. And in that case, the following entry will be passed, therefore, in the books of the consignor for credit sales. Now, in case of credit sales, the entry is passed like this, that consignment account debit and consignment trade receivable, consignment account will be credited and consignment trade receivable account will be debited. So the difference is because in case del creditor commission is paid to consignee, then the consignee is responsible to bear any loss of bad debts and he has to pay full amount of sales to consignor. So accordingly, in a consignor's books, the whole amount, that is cash sale plus the credit sale, is shown as receivable from the consignee. So whatever sales happens there, it is shown as receivable from the consignee. This consignment account credit means this amount is sold. And when we say consignment trade receivable account, it means that this is the account of the consignee being debited. We can just write it like consignee account debit and consignment account credit. And if on the other hand, if the del creditor commission is not paid, then consignor is responsible to bear the loss of bad debts, as we have seen. Therefore, till the time the consignee has not received the money from the customers, it is not shown as receivable from the customers, from the consignee, because del creditor commission is not being paid. So if the del creditor commission was paid, then of course entry is very simple, that all the amount, that is whatever sale has been made, that for that the consignee will be shown as being responsible for it, and therefore consignee account would be in fact debited for the entire amount of sales. So in case del creditor commission is paid, then we'll just say consignee account debit to consignment, because consignee is responsible even if the bad debt is there. But in case del creditor commission is not being paid, then in that case, when we credit the consignment account with sales, we don't credit the consignee straight away. We don't debit the consignee. Instead, we debit the consignee consignment trade receivables account, because part of these receivables will be converted into bad debt later on. That is a more reasonable way to show these entries when the del creditor commission is not being paid. So this is the entry when del creditor commission is not being paid. In that case, debit will go not to the consignee, but it will go to the consignment trade receivable account. And this will be in respect of entire amount of the credit sales. In case of cash sale, of course, the cash has already been received, so consignee will be debited for the entire amount of cash sale. But in case of the credit sale, if we are not paying the credit commission to the consignee, then in that case we will not debit the consignee. We will rather debit the consignment trade receivable account. That is the name of the account we'll create, and we'll debit that account. Now, as and when the amount is being received, it will be transferred from the consignment trade receivable account to the consignee account by crediting the consignment trade receivable account and debiting the consignee account. So this entry out here, consignment trade receivable account debit to consignment account, is in that case where no del creditor commission is being paid. Now let us understand the situation where some normal loss is happening. Certain losses are abnormal losses, which are unavoidable losses, and it would be spread over the entire consignment while valuing the inventories. So the total cost plus the expenses which are incurred will be divided by the quantity available after the normal loss. Now let's say we'll just take an example of it. Okay, let us say, supposing there are 10,000 kilogram of apples and 10,000 kilogram of apples were sent on consignment to a wholesaler, and the cost of each apple was 30 rupees. The cost of per kg cost of apples was 30 rupees, and plus 40,000 was spent on the freight. And we are concluding that 15% loss of the apples is unavoidable. So therefore, we'll have to calculate the per kg cost. We have to divide the to get the per kg cost. We are saying that 85% of the apples are remaining. So out of the 10,000 kilogram of apples, only 8,500 kilogram apples are remaining with us. And if we were to take the cost of those apples, 30, we'll multiply 30 with 10,000. That gives us a value of 3 lakh. And then we add 40,000 as freight. So 3,40,000 is the total cost of 10,000 kg of apples. This divided by the number of apples remaining gives us a value of 40 rupees cost for the apple after the normal loss. Now we are sending this 10,000 kg apples, and let us say a normal loss has happened. So normal loss would be about 1,500 apples, and still unsold inventory is 1,000 kilogram. So since the cost of the apples was 40 rupees after the normal loss, so the unsold inventory will be valued at 40 rupees, and it will be valued at 1,000 into 40, which comes to 40,000 rupees. So here, accordingly, no entry is recorded for normal loss. No separate entry is made for normal loss, and that loss is considered as an expenditure. So, and it is automatically considered for valuation of the remaining inventory. So whatever normal loss is happening, that is being considered for calculating the value of the remaining inventory, and no other loss for the loss. No other entry is required because the loss is being taken into consideration here while calculating the unsold inventory. Now let us say that if some abnormal loss happens, then what happens? So supposing there is an accident or an unnecessary loss which normally doesn't happen, then the proper thing which has to be done is to find out the cost of the goods which have been thus lost. And once we find out the cost of the goods which are lost by abnormal loss, credit the consignment account and debit the profit and loss account with that much of the loss. So this will enable the consignor to know what profit would have been earned if the loss had not taken place. So basically, we have to understand here that an abnormal loss has happened. Now, if we take into consideration abnormal loss, we won't know how much percentage of profit we are making on the consignment. To ascertain the actual percentage of consigned profit being made, the abnormal loss figure should not be there. So therefore, after having calculated the cost of the goods which were lost, we will credit that value to the consignment account. That is to say that we'll add it to the profits of the consignment account and we'll debit it in the profit and loss account. By doing this, some reversal entry is being made here by which we are trying to understand how much is our profit margin on the consignment business after neglecting the abnormal loss. Now, for example, let us say that there are 1,000 swing machines which are each costing 2,500 rupees and 1,000 swing machines each costing 2,500 are sent on consignment basis, and also 10,000 rupees is spent on freight. And after that, we find that 20 machines were damaged beyond repair. Damage means this is abnormal loss has happened due to some accident or something. So the 20 machines, each machine was costing 2,500 rupees. So the cost of these machines which were damaged is 50,000 rupees. And since we have incurred the expenses of 10,000 rupees also, so we will take out of this 10,000 rupees, we'll take a proportionate figure of 20 upon 1,000, because out of the total 1,000 machines, 20 were damaged. So we will allocate this expenditure of freight to the 20 machines by doing a 20 upon 1,000 into 10,000. So we are taking the 20% of 10,000 here, and that is 200 rupees. So basically, the expenditure on 20 machines is 200 rupees, and the cost of the 20 machines is 50,000 rupees. So total cost of the machines is therefore 50,200 rupees, and this amount we have to credit to consignment account and debit to the P&L account. Why we are doing that? Because we are raising the consignment profit to a figure where we are neglecting the abnormal loss, and therefore we are coming to know what is the profit margin on the consignment business. Now, if any amount is received from the insurers, let's say 40,000 rupees, then in this case we will debit only 10,200 rupees to the profit and loss account, because 40,000 is already recovered. So the credit to the consignment account would be only 10,200 rupees rather than 50,200 rupees. Now, what is happening here is that what is being explained here is that should have happened, but actually what is being done is that we are not changing the credit to the consignment account, because even if we have received the money back, it's fine. We are not bothered. Our intention is to find out the profit on the consignment. So whatever loss has happened, abnormal loss has happened, that we add back to the consignment account as a profit, and we debit the profit and loss account and we credit the consignment account. By doing that, we come to know the profit on the consignment that would have happened to us in case this abnormal loss had not happened. It is necessary for us to find out that if that abnormal loss had not happened, how much profit we would have made, because that helps us to ascertain what kind of profits we are making on the consignment business. So obviously, even if we get some money back from the insurance company, that should not affect our calculation of the profit on the consignment. So if we get some money from the insurance, we debit the, let's say 40,000, will debit that money in the bank account, and of course the credit entry would be according to the when we claim the insurance and insurance claim account and things like that, as we would see in in other cases where insurance is claimed. Now, we
Sir,
must
one question.
remember that yes, yes,
Sir,
yes, yes.
just a basic question actually. When there is a loss occurring, actually, why we are crediting this consignment account and debiting this P&L account? Means loss means the money is actually going out of the consignment account. That is the reason we are crediting.
Exactly. What is happening is that when we make the consignment account, we are making a sale of let's say 20 machines are lost. Fine. So on the sale side, we would have entered only 800 machines. Sorry, 980 machines. Correct. Supposing let's say that
Yes, sir.
1000, instead of 1000 machines, we are able to sell only 980 machines because 20 machines are damaged. So when we put the sales figure in the consignment account, then we have automatically not put this 20 machines sales figure there. So our consignment account is reflecting lesser sale than 1000 machines. We are reflecting a 980 machine sale only in the consignment
Yes.
account. Expenses are as usual. So we are not able to know what is our profit margin on the consignment business, because if these machines had not been damaged due to some abnormality, then we would have sold them. So we want to find out what is our actual profit on the consignment business. Any consigner would want to find out, would want to know whether he's going into a loss in the consignment business or he's making a profit in the consignment business. And if he's making a profit, what is his profit margin? Then only it is worthwhile to do the consignment business if there is a reasonable profit there. So he knows that his consignment account is giving an abnormal figure of profit of the profit, because it is giving it a lesser figure of the profit. So he wants to raise the figure appropriately so that he can know what is the profit that is he would have made in case this damage had not happened and this abnormal loss had not been incurred by him. So for that purpose, in order to ascertain the correct amount of profit that he would have obtained, he will credit that amount to the consignment account and debit the P&L account. This is not being done as part of the normal accounts. This is being done to ascertain the actual uh, profit that consignment account, that is he's getting in the consignment account. The main purpose of making this entry is to find out the real profit on the consignment. Real profit means real profit margin on the consignment. The real profit is of course lesser because he has already damaged his 20 machines. Since he has damaged his 20 machines, and if he's not, let's say, he's not getting any insurance, that 20 machines is a loss for him. So it is not a profit for him. So therefore, in his when he will calculate his profit, at that time it would be it would not he would not cancel this loss. This loss would automatically appear. How this loss will automatically appear? Because let us say, for example, that after losing these 20 machines, he is making a profit of 1000 rupees, for example. Now this profit is transferring to the profit and loss account. How he will transfer that profit to the profit and loss account? He will be crediting the profit and loss account and debiting the consignment account. Is that right?
Yes, sir.
So he has credited that P&L account and debited the consignment account. already. Now this, you can see this entry is the reverse of that. He is debiting the P&L, crediting the consignment account. Why is doing that? Just to ascertain what profit he would have made in case he had not incurred this loss. That's the only thing. Now, why he's doing that? In order to be able to value his stock properly.
Okay.
For that reason, he's doing this. So
that means, sir,
otherwise he won't be able to value his stock in a correct way. So abnormal loss is therefore valued just like inventories in hand, because here also expenses are being added. In case of the abnormal loss also, inventories, just like we value the inventory, similarly it is being abnormal loss is also being valued in the same way. So let us read through it entirely, then I think your remaining doubt should also be cleared.
So basically this entry is being made to actually show the erosion of money due to the loss, which would have been otherwise received had there been no loss.
Yes, yes. So because yes, exactly. And therefore, once he has calculated the abnormal loss, once he has calculated, since we are already reading through it, let us read the whole thing, how it is being used in the valuation of inventory. Then it will become very clear to you.
Okay, sir.
Now, abnormal loss is valued just like inventories in hand. This statement only says that just like we are valuing the inventory, similarly we are valuing the abnormal loss here. First thing. Now, while valuing the goods which are lost in transit and the goods which are lost in consignees go down, there are two types of losses can be there. One is that consignor has sent the goods to consignee and they are lost in transit. Other thing is that consignee had received the goods and it were lying in his godown. They were lying in his godown and the loss happened there due to fire or something like that. Now both these situations are abnormal loss situations. But in the case of the former, that is where goods are lost in transit, consignees' non-recurring expenses are not to be included while valuing these, whereas when we are valuing the abnormal loss of the consignees go down, then we will be including the consignees' non-recurring expenses. Non-recurring expenses means those expenses which had to be incurred due to the loss happening. Recurring expenses are those expenses which keep on happening in the normal course of business. Non-recurring, why they are non-recurring? Because some abnormal loss is happening and therefore some expenses would get incurred to tackle the abnormal loss situation. So when we are valuing those, when we are valuing the loss, or when we are valuing the goods which are lost in transit, in that case, will not be including the expenses, the non-recurring expenses consignee has incurred, because the goods were in transit and consignee's expenses, whatever he may have incurred, non-recurring expenses, that would not be affecting the value of those goods which were lost in transit. And therefore, non-recurring expenses would not be added in that case. It is very obvious also that those non-recurring expenses have not been incurred in relation to the goods lost in transit. So why should they be added in any case? And therefore, but if the goods are lost in the consignees go down, then these non-recurring expenses, which happen to be incurred due to this abnormal loss, the non-recurring expenses, they will be included while valuing those goods which are lost in the consignees go down. Now, the loss which is happening is what? It is the loss is happening is of the goods. So basically, when we are valuing the goods, we are trying to find out that what is the loss that has happened to the business due to the loss of the goods. So there could be different kinds of losses that could happen in different situations. When the goods are in transit, the calculation could be different. When the goods are in consignees go down, the calculation could be different. So therefore, there could be two different kind of calculations of the value of the lost goods, depending upon the situation, whether they were goods in transit or they were goods in the consignees go down. They could be these two different situations could be there. Now, when we come to the inventory in hand, so for the purpose of the valuation of the inventory in hand, normal loss is considered as part of the cost of the remaining goods, whereas the abnormal loss, if it has happened, it would be ignored to calculate the valuation of the inventory which is in our hand. So this abnormal loss has to be ignored while valuing the goods which are in our hand. But during the course of the making of the consignment account, we have not ignored these abnormal losses. So therefore, we need to ignore these abnormal losses to be able to calculate the valuation of the goods in hand correctly. So let us say in the example which was given above, there were 10,000 kilograms of apples were sent. 10,000 kilograms of apples were sent in 10 different trucks. 10 different trucks means every truck was having approximately 1,000 kgs of apples. And out of these 10 different trucks, one truck had an accident. And so from that truck, 500 kilograms of apples were destroyed due to the accident. So in all, 5,000 kilograms of apples have been destroyed. So we have to now calculate the cost of the remaining apples. So total apples were 10,000. Okay. And 3,40,000 was the amount here. So as we can see here above in the above example, 10,000 apples and 30 rupees was the cost of each apple per kg. 40,000 was the freight that was paid. So total cost comes to 30 into 10,000, 3 lakh plus 40,000, 3 lakh 40,000. So 3 lakh 40,000 is the amount of these 10,000 apples, which is the cost. So when we look at it, it comes to about 34 rupees per kg, which is including freight, that is the cost. Then apples which were lost were 500. So 500 into 34 rupees. That means that 500 into 34 means 17,000 rupees. Apples were lost. So the remaining apples are now 9,500 rupees, and they are the amount of the cost of those apples is 3,23,000 rupees. So now here, then we come to this normal loss is 15%, because normal loss will automatically happen in any case. You cannot avoid normal loss from happening. So since normal loss is 15%, we calculate 15% of 9,500. Then let us say that 9,500 apples, out of these 1,425 more apples were lost. So when these apples were again lost, so the value, because we are getting from these apples is nil. So therefore we were calculating nil here. We are left with 8,075 apples. We are left with 8,075 apples, and 3,23,000 is the cost of those apples. 3,23,000 is the cost of those apples. And when we divide 3,23,000 with 8,075, we get a figure of 40 rupees per kg. So therefore, what we are doing is that this is the cost. The 40 rupees per kg is the cost of the remaining saleable apples after the abnormal loss and the normal loss. So the 3,23,000 rupees is the 40 rupees per kg is the cost of the remaining saleable apples. So this is the way the cost of the remaining saleable apples will be calculated. So abnormal loss, as we are seeing, the abnormal loss will not have impact on per unit cost, as we are seeing here, because per unit cost is remaining same, 34 rupees per kg, even after the abnormal loss, and even before the abnormal loss, it is 34 rupees per kg. So abnormal loss is not having any impact on per unit cost. However, per unit cost will change due to the normal cost, because the remaining quantity will absorb the cost of the normal loss. The normal cost loss is bound to happen, whereas abnormal loss will be sent to the profit or loss, because abnormal loss is a straightforward loss and it does not get loaded on to the price, and therefore if any abnormal loss is happening, it is the loss of the it is a straightforward loss of the consignment business. It will not be affecting the value per unit cost of the items. So this has to be remembered very clearly, that whenever an abnormal loss is happening, it will not impact on the per unit cost at all, because of the fact that abnormal loss will automatically increase the loss of the consignment business by the same amount as much as the abnormal loss is. So it will not load on to the price or to the cost at all. But as far as normal loss is concerned, normal loss cost, the normal loss will certainly load on to the because the same amount will be now distributed over lesser number of apples. Because if there were more number of apples, the cost per kg would be lesser. But here, since lesser number of apples are there, the total cost is remaining the same, and therefore that cost will be borne by now 8,075 apples instead of 9,500 apples, and therefore now the unit cost would be more after the normal loss. So that is the basic difference between normal loss and abnormal loss, and how it is to be accounted for here. So what we have calculated here is that the cost of the remaining apples we are computing. So let us say that out of these 8,075 apples, 1,000 apples are remaining which are not sold. So they will be valued at the cost of rupees 40. So our cost of the remaining inventory in that case will be 40,000 rupees if 1,000 apples are remaining unsold. That is what is the impact of the normal loss and the abnormal loss. If any abnormal loss would have happened, there would have been no change in the cost. So now we go on to the differences between the normal loss and abnormal loss. But I think that we'll cover in the next part of the session. So please think about and chew these facts, and come back in the morning at 8 a.m. We'll start at 8 a.m. So 7:45 you can join in by 7:45. So do join us tomorrow morning once again at 7:45 a.m. for the next part of this session on consignment accounts. We have a lot of ground to cover, so please come with your questions and your thoughts. Thank you very much for having joined us for this session.